Talk to you really quickly about the quizzes.
Okay, folks. So you had a long weekend to get caught up, right? A couple of very quick announcements before I get started. I don't think there's anybody with an announcement this morning, so I'm going to dive in. The first thing is that I was checking the Google shared spreadsheet of your companies, and as the numbers go along, and about half of you haven't been there yet. So I will probably start reaching out and saying, have you picked a company? So if you don't want that personal email saying, what's your company? Hey, just go in and enter the damn company, you know. And it's not just the company. As you go along, I ask you to enter numbers as you go along. What currency are you doing your analysis in? What risk-free rate? Again, it's my way of saying, hey, you're falling behind, you might want to get caught up. So it's like an internal nagging mechanism that will keep going through the entire semester. The second announcement is something that has been on the calendar all the way through, but people are always surprised when it happens, which is a week from Monday, you have your first quiz, right? So I will give you, obviously the nagging about the quiz will start really soon. I will send you the past quizzes. I will send you there are lots of logistical details we have to work through, including the fact that we can't all take the quiz in this room. Don't ask me why, just look around you. It's just like we're crammed into each other. This is not an easy room to take an open book, open notes quiz, especially the kinds of books and notes some people will bring to the quiz. It's like they think with 30 minutes they can have a library of stuff around them. So there will be a second room, and I will tell you which room to go to. It'll be in the first 30 minutes of the class. Okay? But all the details will follow, so you'll have that. So something to start thinking about. If you've been putting off kind of getting into the substance of the class, this is a weekend, a good weekend to start getting caught up on that part of the class as well. So towards the end of class last Wednesday, and we've had a long break, so you might have forgotten what we were doing. We're talking about equity risk premiums, right? How to come up with the equity risk premium for a company. And let me again separate out coming up with an equity risk premium for a country from equity risk premium for a company. To come up with an equity risk premium for a country, you start with the mature market premium, which in my case I use the US as my base, which I update every month. And on top of that, I build an additional premium based on your default spread as a country and the additional risk of equities. So you come up with an equity risk premium for a country, and you saw that picture, the global picture of equity risk premiums. But to bring that down to your company, you have to answer a follow-up question, which is, Not where your company is incorporated. Frankly, I don't care, but where it does business. And here you're grappling with the data that you have, not the data that you wished you had. So you open up the 10K or the annual report. Most of your companies will tell you where they do business. Some do it more explicitly than others and better than others. And it's always been something that frustrates me, that companies are so opaque about the way they reveal where they do business. It's one of the fundamental things I need as an investor. I need to know whether you have a lot of business in Venezuela, because right now, what value I attach to you as a company is going to be affected by that. But as you look at your companies, some of you are going to discover that your company breaks down in excruciating detail where it does business. Royal Dutch, for instance, its reserves, it breaks down by country, 53 countries. But for some of you, it's going to be much more, the breakdown is not going to be as specific as you want. So I was, there were about 30 emails I probably got between last Wednesday and this one, relating to individual companies. My company breaks its revenues down into the US and the rest of the world. What do I do? And the answer is I don't know. So if you expected me to say, I know what the rest of the world looks like, here's the breakdown, I mean, you're giving me information and knowledge I don't have. So I said, do the best you can. I mean, you have exactly the same information that I have. The rest of the world is a big place. And I've given you essentially one reason I give you that table of equity risk premiums by country and the GDP for each country is, let's face it, if you tell me the rest of the world and I have to guess, my guess is you get more of your revenues in Europe than in Africa. Why? Because Europe in terms of GDP is 10 times or 20 times larger than Africa. And if you tell me that you get 30% of your revenues in Asia, I'm going to guess that a bigger chunk of those revenues come from China than from Vietnam. So do the best you can. There's nothing more you can do. I mean, if you were able to face up to the company and ask them specific questions, you might be able to extract the information. But do the best you can to come up with that weighted average for your company. One reason I focus on revenues is partly because accountants can't screw it up too much. And the second is, it is the one piece of information you will tend to find for most companies. But again, remember, for your company, you might decide that revenue is not the best basis for estimating equity risk. I gave you the example of Royal Dutch. As an oil company, I don't care where you sell your stuff. I care about where your oil comes from. So for Royal Dutch, when I do my equity risk premium, I'm going to do a weighted average based on where your reserves are. So make your best judgment, come up with an equity risk premium for your company. So at this stage, assuming you've caught up with me, here's what you have for your company. You have a currency choice, a risk-free rate in that currency, whether it's US dollars, euros, Indian rupees, whatever, and an equity risk premium for your company. To get to that final piece, to use this in the CAPM, a risk-free rate and equity risk premium, what's the last number I need? The beta, right? So I'm going to throw this question out, and I want somebody who's worked in corporate finance, perhaps an investment bank, who use betas in their jobs. And let's face it, if you worked in an investment bank, you worked in corporate finance, you were using betas somewhere. Well or badly, we won't discuss, but you were using betas in your analysis. I have a question. First, I want to show of hands of people who worked in jobs that required them to use betas. You don't want to? Okay. So I'm going to pick on you since you're one of the few people actually admitted. When you had to get a beta for a company to use in your job, not in a classroom, where do you get the beta? Bloomberg. And you're not alone. In fact, whenever I go into an investment bank, and they ask me to do these re-education camps sometimes, for bankers who might have forgotten some basics. I throw this question out, where do betas come from? One guy actually with a very convoluted explanation of where babies came from. I said, no, you misunderstood the question. I have 4 of those and they're all grown up. I kind of know where babies come from. I want to know where betas come from. And after hemming and hawing, the answer usually is from Bloomberg, from Barra. Let's face it, once you start working, betas come from outside, from a service. But if you dig a little deeper, if you've taken a corporate finance class, in fact, if you've taken any first-level finance class, you were probably taught betas exactly the same way I was taught betas. I was told betas come from regressions, a regression of returns on your stock against returns in a market index. The slope of the line is the beta. It's a simple regression. One variable, your dependent variable is the stock, your independent variable is the market. Beta is the slope of the line. That's the way I was taught betas, and that's the way generations of finance students have been taught betas. That's a statistical approach, right? It's a regression. And when you run a regression, in addition to the slope of the regression, think about what you get as output. You get an intercept. And you also get an R squared. Now, normally people throw those away, but I'm going to argue that if you run a regression for your company to get a beta, you're actually getting other information about your company that you can extract from that regression. And in particular, I'm going to argue that the slope, the slope tells you what the risk is. The intercept tells you something about the performance of your stock during the period of your regression. Let me explain. You take a stock, give the stock a name, Tesla, Google, Facebook, Twitter. You look at the last 2 years. Some of these stocks did really well. Facebook clearly did really well. Some of these stocks did really badly. Twitter did really badly. So when you run a regression, your intercept is going to tell you whether your stock was a Facebook or a Twitter, whether it did well during the period or badly during the period. And I'm going to talk about how to extract that information by looking at that intercept. And then let's look at the R squared. The R squared in any statistical, if this were a statistics class, if I asked you what the R squared was, what's the statistical explanation for R squared? What does it tell you? It's the proportion of the variation in your dependent variable that is explained by your independent variable, right? What's your dependent variable here? The stock. What's your independent variable? The market. So let me restate it in terms of this regression. The R squared tells you what proportion of the risk in your stock comes from the market. Why is that even significant? Remember the second step in risk and return models in finance? What do? We broke risk down into risk that can be diversified away and risk that cannot. I'm going to argue that the R squared is going to give you an early signal of how much of the risk in your stock you can remove by diversifying. This is not a statistical exercise. When you run a regression in finance, you're trying to get signals, cues about your company, and the slope tells you something about risk, the intercept tells you something about performance, and the R squared tells you something about where the risk in the stock is coming from, and all three pieces of information will be useful to you as you go forward with this company. So let's take a look at that intercept and let's see why it tells you something about the stock. If you take the original CAPM, in the original CAPM, the return on a stock is the risk-free rate plus beta times RM minus RF. That's the way the CAPM is actually presented. Let's do some basic algebra, move some terms around, and I promise I'm not screwing up the equation. I can rewrite the CAPM as risk-free rate times 1 minus beta plus beta times RF. So basically that's a traditional CAPM. Now think of what I've run as a regression. I've regressed returns on the stock against returns on the market, right? The slope is the beta. If you compare those two equations, you can already see that if my stock delivered exactly what the CAPM said it should during the period, my intercept for my regression should be exactly equal to the risk-free rate times 1 minus beta. So here's what I'm going to do. I'm going to run the regression. I'm going to look at the intercept. I'm going to compare that intercept to the risk-free rate times 1 minus beta. And if the numbers are roughly the same, I'm going to say your stock did about as well as I expected it to do over the last 2 years. If I run the regression, I get an intercept that's 10 times bigger than my risk-free rate times 1 minus beta. I'm going to say, congratulations, you picked a great stock. And if it's well below the risk-free rate times 1 minus beta, I'm going to say, my condolences. That was a bad investment you made. The risk-free rate times 1 minus beta becomes a measure of what your stock needs to make. The intercept becomes what it actually makes. The difference between those two numbers is called Jensen's alpha. You're saying, who's Jensen and why do you call it an alpha? The alpha part is easy. When you run a regression in statistics, the intercept is usually called the alpha. So it called it alpha for that reason. It's called Jensen's alpha because it was created by a guy called Mike Jensen in the 1960s. The University of Chicago, which is where the finance got its start, in the University of Chicago. And he created it for a very specific purpose. Up until the 1960s, the presumption was that professional money managers must make more than the rest of us who are amateurs. Why? Because they're professional. I mean, after all, a doctor should treat a disease better than somebody who walks off the street and says, let me guess what's wrong with you. We're not even sure that's true, but the assumption was if you're a professional money manager, those mutual fund managers, you must make more than somebody who just picks stocks on their own. Nobody even tested it. They assumed that that was true because these were smart people, they knew how to manage money, they had access to information. And Mike Jensen asked the question, is that true? That's the basis of research, right? You take something that everybody takes for granted and say, hey, is that true? So to test out the proposition, that's what he did. He looked at the Jensen's alpha. Remember, the Jensen's alpha is what you make over and above what you need to make of mutual funds. If the presumption is right, what should you see? That on average, mutual funds deliver more than their Jensen's alpha should be positive. They should be picking stocks that make more than expected. They should have a positive Jensen's alpha. And the rest of us, the suckers, should have negative Jensen's alphas, which would feed into this game of professional money managers taking the suckers to the game and taking their money away from them. But that's not what he found. He looked at 125 mutual funds. You're saying, why only 125? In the days before computers, there was a reason why sample sizes were limited. Right? It put a natural cap because you had to actually physically enter the numbers and do your own regression. The other was there weren't that many mutual funds in the 60s. So he took 125 mutual funds. And what he found has become one of the most enduring findings in finance. He found that 70% plus of those mutual funds had negative Jensen's alphas. That collectively they picked stocks that earned less than they should, not more. That the average Jensen's alpha across mutual funds was between -1 and -1.5%. In other words, collectively they earned a return 1 to 1.5% less than what you could make on the index. When he did this research, though, what you could make on the index was an abstraction. You couldn't actually invest in the index in 1969. But his research actually was read by a guy called Jack Bogle, who used to work at Vanguard, and he said, this is interesting. These guys all take money from investors, and they deliver 1.5% less than the index. What if I could create a mutual fund that hired no analysts, did no stock picking, but just held the index? And out of that was born the Vanguard 500 Index Fund, the greatest disruptor in history. Because if you think about the amount of money that's left active money management and gone into index funds, it is the greatest disruption in history in terms of the billions of dollars that have left. But that was the basis for the index fund business. So Jensen's alpha has this very, very rich history in terms of what effect it has had on active money management. But when he did this, he didn't expect all of this to come out of it. He thought he was going to find the presumption to be true. He was actually surprised when he wrote the paper. He said, I can't believe this, but I'm going to write it anyway. It looks like active money managers take your money to lose money for you. And ever since we've wrestled with that paradox as well, why would you pay somebody to earn 1% or 1.5% less than the index? But that's a question for a different audience, a different reason, a different, maybe a behavioral class as to why hope springs eternal. But that's Jensen's alpha, and we're going to use the intercept to back into it. So let's go through the mechanics here. I want to run a regression, right? Yes, go ahead. I'm sorry? Okay, that is after fees, the returns you get. But that's small consolation. If you tell me, look, before fees, I broke even, I don't care. Then give me back the fees. If the before fees, then I'll be okay with this. So, in fact, there's a mathematical reason why active money managers can never beat the market. You see why? Let's say this half of the class, so I'll draw the line right down the middle. You guys are going to invest in index funds and ETFs. You're right, so you have to be half the, and this side of the class, you're going to be active money managers. This is the entire market. So you're running index funds. Collectively, what are you going to make as a return over the next year? You're going to basically match the market, your index funds, right? Net of that 10 basis point cost or whatever it is that you run. So collectively, passive investing is going to make the market. So now let's look at the active side. If collectively that half of the class makes the market, collectively what does this half of the class have to make? Also have to make the market. The only difference though is they're spending almost nothing to match the market. What are you spending? I'm going to go to Fidelity in a couple of weeks at 333 Summer Street or whatever, that 50-story building filled with people doing something who are being paid something to do something. That's going to cost you money. Collectively, you're spending 1 to 1.5%. So at the end of the year, when I look at the returns made by index funds, I'm going to get the market return minus 10 basis points. When I look at the returns made by the rest of you, I'm going to get the market return minus. This is almost destined for doom, right? You know what the defense you have to offer as an active money manager has to be? You got to turn to the rest of the class and say, it's those guys. I am the good guy. They're pulling the average down, and that's what every active money management group I present this to, that's all. It's the guys outside this room you're talking about. It's not us. And this is, of course, they don't show us your actual results, but that's where hope springs eternal, that even though this is true across the entire group, maybe there's a subset, value investors, people who do research, where it's not true. I won't let you know all the bad news on what happens when you go to those layers, but that's what keeps this process going. And already you can see why disruption is working in this business. You are, I hate to use this analogy, you're like yellow cabs. I'm talking about you active money managers in the age of Uber. And we know how that game is going to end. It's not going to end well. You might be left with enclaves where you have to go with you guys, but it is a game that for the last decade, active money management has been fighting and losing for an obvious reason. So let's talk about the mechanics of running this regression. You look at any book, it says run a regression of returns in the stock against returns on market index. That sounds simple, right? But there are lots of estimation choices you have to make along the way. Let me use Disney as my example. I want to run a regression for Disney against a market index. Here's the first decision I have to make. How far back am I going to go to run this regression? Let me back up. Disney has been a publicly traded company since the 1950s. I could go back and run a regression from 1958 through 2016. That's good, right? Statistics, more data is better than less data, but tell me what the trade-off is. Why might I not want to go back to 1957 or 58 to start this regression? What's my end game? Why am I estimating this beta? To get an expected return for the future, right? What's the problem with going back to 1958? In fact, in 1958, Disney was a one-movie company. Every year they released one animated movie. And they just started their first theme park. And Anaheim had just opened up. It was really an animated movie company with one movie a year. Think of what Disney is today, right? It's in broadcasting, it's in theme parks, it's in movies. It's a very different company. So here's the trade-off. If you go back too far, you're going to get a company that doesn't resemble today's company. If you don't go back far enough, you don't have enough data. So this is the dance that every service runs. How far back should we go? And if you look at Bloomberg, you know what the default is? When you ask for a beta for your company in Bloomberg, did anybody print off your beta page? If you did you check to see what default they ran into? It's 2 years. That's a Bloomberg default. Value Line uses 5 years. S&P Capital IQ does 2 and 5. But basically 2 to 5 is pretty much the standard in this, because beyond 5 years you're asking for trouble. How many companies don't change? You know, if you go to 10 or 15 or 20 years. So 2 to 5 years tends to be the default for most services. You can't go below 2 because then your data starts to get, there's not enough data to run the regression. It's a statistical problem. You had a question? We're going to get to that. That's step 3. So let's start. Let's do this one step at a time. So let's get the time period first done, 2 to 5 years. Second, you have to decide how you're going to slice up those 2 to 5 years. You know what I mean by slice up? I can take the 2 years of data and break them into daily returns, which gives me about 500 days of returns. It's 250 trading days a year. I can break them down into weekly returns, which will give me 104 observations. I can break them down into monthly returns, which will give me about 24 observations, or quarterly returns where I'll get only 8 observations. Again, here's a trade-off. If you slice it down too broadly into quarters, you don't have enough data. Even with 5 years, you're looking at 20 observations. If you cut it down too fine into daily returns, you add a lot of noise into your regression, and here's why. When we think of daily returns, we think about end of day, every day, 4 o'clock, we get the price, we get a return, right? If your stock trades continuously, like Disney does, that's not a big deal. Your 4 o'clock return represents a trade done at 3:58. But if you have a lightly traded stock, your 4 o'clock return might represent a trade done at 11:55. You're saying, so what? What if the market dropped 2% between noon and 4 o'clock? Your return represents a return from a point in time when the market must have been 3% higher or 4% higher. You mismatch, and your betas start to very quickly become 1 for every company. Daily return betas, very early in this process, we discovered added too much noise to the process, so we threw them away. So the choices you'll see services make is weekly or monthly. Again, if you look at Bloomberg, they use weekly returns, but Value Line uses monthly returns. You're saying, why? Value Line uses 5 years of data, so they can afford to use monthly returns. They get 60 months of data. Bloomberg, I said, uses only 2 years of data, so in a sense, you're almost 4. So if you make your estimation period 2 years, you're going to be pushed towards weekly. If you have a longer period, you might go to monthly, but you never see return intervals that exceed a month. So week to a month. Is that a seat that's squeaking? Is my mic is doing it? Why is it coming from the back? It sounds disembodied. Start taking off my clothes. Mind me. That's a threat. So at this stage, you pick the time period, you pick the return interval. Third step, and now we're ready. What market index should you use? That's a good point. Do you know how many market indices there are just in the US? At least 125. Let's name some of the more. When we think about market indices in the US, let's start listing some names. Yeah? What's the most, when people still talk about the market, for better or worse? I wish it were the S&P. What's CNBC or NBC? It is the Dow still. For whatever reason, we are attached to the Dow. Okay, so there's the Dow 30. Then, of course, there's the S&P 500. Let's keep going. What else? NASDAQ, NYSE Composite, Wilshire 5000. So basically, you can go down the list. And guess what? If you run a Bloomberg regression, here's something you can do. Try this the next time you can get on Bloomberg. When you run a beta regression for your company, it'll run it against a default index. For a US company, it runs it against the S&P 500. We'll come back and talk about why. You can actually change that index if you want. You can change it to the Dow 30. You can change it to the NYSE, the NASDAQ, the NYSE, the Wilshire 5000. You can even change it to the MSCI. You know what the MSCI is? It's a global equity index. And guess what? You will get different betas against. This is extremely convenient if you're an analyst. You know why, right? I've told people, you give me a Bloomberg terminal, give me 30 minutes, tell me what beta you want for your company. And I will deliver a printed page with a beta. Exactly the beta you want. 0.81, second decimal point I can do it. Because there are so many choices I can make. What is my time period? What return interval? What's my index? Trade price, bid price. It's almost like Bloomberg is begging you to play games with the beta page. But let's get back to what we're trying to do. We're trying to estimate a beta for what's the model that's driving all of this? The capital asset pricing model, right? Do you remember when we derived the model and I removed transactions costs and I removed private information, what we all ended up holding? We held the market portfolio. Remind me again what's in the market portfolio. Every single traded asset in the world in proportion to its market value. There's your ideal. You'd like to run the regression against an index that includes every single traded asset in the world, and there is very little chance you'll find an index like that, but you can aspire to be there. So now let me go down the list and you tell me why this index should or should not be used to get the beta for your company. Why shouldn't I use the Dow 30? It's easy, come on. It's only 30 stocks. I don't care what those 30 stocks are. 30 stocks out of 42,000 is asking for trouble. So the Dow 30 is off the table. What's the problem with the NASDAQ? It's really not a market index. It's a tech index, right? If you remove those 5 big tech companies, there's nothing left of the index. I'm not getting a beta against the market. I'm getting a beta against technology stocks. NASDAQ is off the table. The NYSE composite looks promising. It's about 2,000 stocks. But it's a price-weighted index, not a market cap-weighted index. You know what a price-weighted index is? GE trades at 30. Some small company trades at 30. They're both weighted the same in the NYSE composite. It's a fatal flaw. So that doesn't work. Almost by default, people end up with the S&P 500. It's only 500 companies, but what's its saving grace? It's the 500 largest market cap companies held in proportion to their market value. But I think it has a fatal flaw as well. A flaw that was not as noticeable 30 years ago, but is increasingly noticeable today. When I talked about the market portfolio, I said every traded asset in the world. So first, it does not include non-stock assets. Already, that's one of the problems. You're running a stock index when, in fact, you'd like a traded asset index. But did I say stocks only in the US? No, there's nothing in the CAPM that talks about the US versus Japan. So the portfolio could presumably include every traded asset in the world, right? 30 years ago, I said, who does that? That's going to be so difficult. It's almost impossible. I can't buy Indian stocks and Chinese stocks. Come on, you can now, right? You see where I'm going next? If we stay true to the CAPM and a market portfolio, I think increasingly every beta estimation service has to start moving away from domestic indices to a global index. But for whatever reason, it's not happening fast enough. Partly because there isn't a single global index that people trust. The MSCI comes with its own share of problems. But you're starting to see S&P try to create a global index. It doesn't have to be all 42,000 companies. It will be a global market cap weighted index. But I have a feeling we're going to end up there sooner or later because that's what we'd like to measure. What's the beta of Apple against that global index? Because half the investors in Apple are not US investors. They're global investors who happen to own Apple as part of their portfolios. And if they're US investors like BlackRock, which happens to own the rest of the world in their portfolios. So when you think about market indices, the prevailing practice is to still stay domestic. And that's going to create a whole host of problems for you when you look at your regression beta that you can't do much about right now. But that's the third choice. Did that answer your question about the market index? Yeah. We'll come back to that because, as I said, it's going to create some fatal problems with some beta estimates. Yeah. It sounds like you can get anything. But if you want a discount rate, no model will ever stop you from a preconception. If you're an idiot savant, is that even an acceptable word anymore? I mean, whatever it is. You know, the Mozart was an idiot savant. He could play music, but he could do nothing else. If you're a discount rate idiot savant, you can just sense discount rates. You can look at it and go, oh, the discount rate is 8.33%. You can back into that discount rate using the model. Bias is impossible to overcome in finance. If you let preconceptions drive your process, no model is ever going to stop you. Don't blame the model for your biases, right? And it's not true anything goes. I said you could use the Dow 30 for the CAPM, but if you do, you're not using the CAPM. Most of the people who violate the CAPM violate it because they violate the basic presumptions. They think of beta as a regression slope. It's not. It's a regression that's supposed to be against an index that includes every traded asset. And the closer you get to that, the better. And once you start respecting that, your betas can't be any number because you can't use the Dow 30 just because you feel like it. Or the NASDAQ because you feel like it, because it fails that test. Yep.
I mean, the other problem with it that you just mentioned is that you could use data to actually run the regression from the past. It might be good for you.
That's a good I accept that problem. And I'm going to come back and talk about why I'm not used to regression beta in corporate finance evaluation almost 25 years. So that's actually an excellent point. I would never do a valuation based on a single regression beta. You know why? Not only is it backward looking, it's one slice of history. Strange things can happen in a slice. And I'm going to show you some betas that you look at and say, no way is that the true beta. I'm going to show you Valiant's beta, 0.3. Do you really think Valiant is a safe company? I don't, but the regression beta says it's safe. We'll talk about why that happens with regression betas. But for the moment, let's build up to the conventional regression beta before tearing it down, because you have choices along the way. What's the last estimation decision? You got to estimate returns, right? Let me ask you a question. When you buy stocks, what are the two ways you make money? One is every 3 months or 6 months or a year, you get dividends. The other is price change from period to period, which happens all the time. So to compute returns, I've got to take price change and dividend, if you have dividends. And if your company doesn't have a dividend, of course, I can ignore it. And look at it as a percentage of the price you paid at the start of the period. And I've got to do this both for your stock and for the index. So for Disney, here's what I'm going to do. I'm going to use the S&P 500 as my starting point, just to see what the Bloomberg beta looks like relative to mine. I'm going to use 5 years, and I'm going to use monthly returns. I like 5-year monthly returns. I think they give you much more reliable beta estimates than 2-year weeklies, because 2 years strange things can happen. I'm going to compute the returns for Disney every month for those 60 months. Actually 59, because I lose the first month. You know what I mean by computing returns in Disney? Let me take an example. December of 2009. So I'm sitting there with a spreadsheet. What did I make in December of 2009? The price at the end of November was $30.22. The price at the end of December was $32.25. So during the month, the price went up $2.03. That's your price change. During the month, there was actually a dividend month. You see, how do I know which month is a dividend month? With stocks, there is a date called the ex-dividend date. That's the date by which you have to own the stock to collect the return. In fact, in the Wall Street Journal, you see an X against the stock. That's usually because it was an ex-dividend date that day. There happened to be an ex-dividend day during the month where the dividend was 35 cents. So if you held the stock during the month, you'd have made $2.03 from price appreciation plus 35 cents in dividends. As a percentage of 30/22, that gives me a return for Disney in December of 2009 of 7.88%. I got the return for 1 month. I do this for every month with an Excel spreadsheet. Of course, this is easy. You just copy and paste down. But when I remember when I first used to give this project, people actually had to collect prices by hand, put them into an Excel spreadsheet, and do it themselves. So basically, it was a lot more tedious to do it then, but no, it's pretty simple to do. So I have the return for Disney, and I do this for every one of the 59 months. Then I take the index. There are two ways you make money on the index as well. One is the change in the index level. So when you look at the Wall Street Journal, when it reports the S&P 500, that's just the price level of the index. So if you take the change in the level of the index, that's how much you made from price appreciation on the index. But the index also pays dividends. It's actually the companies in the index pay dividends. So at least some of the 500 companies will pay dividends in January, February, March. That dividend is captured in the second term. And the return on the index in that 1 month was 1.78%. So in December of 2009, if I looked at Disney, Disney had a really good month. It was up 7.88%. The market had a decent month. It was up 1.7. And I do this for every month for 59 months. So visualize the spreadsheet. When I'm done, I'm going to have 59 months of returns on Disney, 59 months of returns on the index. And I have to run a regression. So I pulled up that Excel analysis tool. I mean, it's in there already. And I first did a scatter plot. I don't know about you, but I remember when I was taught statistics, I was told, before you run a regression, visualize the data. And the easiest way to visualize whether there's a relationship between two variables is to run a scatter plot. What's a scatter plot? You take each month of data and you plot it on the graph. So there should be 59 points. So those of your type A personalities or whatever, you can start counting. There should be 59 points. So when I'm done, I have 59 points. What's the definition of, what's the best fit line in a regression? When you run a regression on Minitab or Excel, what does it do? It's sum of least squares, but tell me in terms, Basically what you do is you try to fit a line through where the square distances from the line are minimized. If you ever get a chance, go back and look at how regressions were done in the 60s and the 70s. Here's what you actually had to do. You had to draw the line. You have to measure the distance of each point from the line. You have to square the distance and minimize this. Thank God we don't live in the 60s and the 70s. But that's what that Excel package or Minitab is doing. It's putting the best fit line. There's the best fit line. We're almost there. When you look at the output from this regression, here's what I get. I get an intercept of 0.0071. For the moment, just leave it as is. That's about 0.71%. I get a slope of 1.25. What does that tell me again? If I believe this regression, my beta for Disney is 1.25. What the hell is this number in brackets below? That's truth in advertising. Something we forget after we leave our statistics classes. You run a regression, you get a slope. The slope is an estimate, it's not a fact. I'm telling you how much standard error there is in my beta estimate. So we'll come back and use that. The beta is 1.25. I'm saying, by the way, before you use it, I'm not that sure about the beta. There is a standard error of 0.10 on the beta. And the R squared of the regression is 73%. I'm going to use this regression output to make sense of Disney as a company over the period of this regression. So this is 2008 through 2013. I have the regression. Let's start with the intercept. What did I say the intercept told you? How good or bad your stock was as an investment during the period if I compare to the risk-free rate times 1 minus beta. So let me start with that. The intercept that I get for Disney, if I convert into percentages, because I ran the regression decimals, is 0.712%. Let's round up 0.71%. You're saying this is good, it's positive. Well, I'm not quite ready to make that jump yet because I have to compare it to the risk-free rate times 1 minus beta. And here's where you have to start to be careful about the details. When I ran this regression, I used monthly returns, right? This is a monthly intercept. So when I do my risk-free rate, I need a monthly risk-free rate. I can't just use the annualized risk-free rate of 2.5% or 3 or 4%. The monthly risk-free rate during this period, and I'm using 1 month T-bill rates, just because, remember, the holding period I have is 1 month. The average T-bill rate was 0.5%. But that's an annualized rate. You divide that by 12, and if you want to be precise, you can raise it to the power 112 if you want. It won't make that much of a difference. I get a risk-free rate on a monthly basis of about 0.04%. Hang in there with me. We're layering details on top of details. So on a monthly basis, a risk-free investment would have made me about 0.04% a month. I multiply by 1 minus the beta. The beta here is 1.25. I end up with minus 0.01%. You say, what does that even mean? If Disney had done exactly as the CAPM predicted during the period of this regression, the intercept should have been minus 0.01%. The actual intercept was 0.71%. You take the difference between those two numbers, you get 0.72%. That is my Jensen's alpha for Disney on a monthly basis. You say 0.72%, who cares? That's monthly. If you think about earning that every month for 12 months, I use the compounding because money earns money. The Jensen's alpha for Disney on an annualized basis over the 5 years of this regression was about 9%. I'll give you a very simple way of thinking about what Jensen's alpha is. Let's say you buy a really risky stock. How risky? Its beta is 2. It's twice as risky as the market. The market goes up 20%. Let's act as if the risk-free rate is close to 0. Market's up 20%. You bought a stock twice as risky as the market. How much do you need to make to break even on the stock? It's twice as risky. Market's up 20%. No risk-free rate. You'd have to make 40%, right? So if I make 40% of the stock, I'm not dancing in the street. That's exactly what I need to make in a period where the market, you're saying, that's so greedy. You know why I need to make 40% the market's up 20%? Because I've got to build up some fat to burn off on the way down. Because when the market's down 10%, guess what my stock's going to do? It's going to be down 20%. So if I don't make more than the market in the up years, I'm going to be wiped out in the down years. So I need to make 40%. When I tell you the Jensen's alpha for the stock is 9%, here's what it did. It made 40% plus 9%. It made 49%. So it beat what I needed to make, given what the market did and given the risk of the stock. It's a risk-adjusted, market-adjusted measure of performance. And it tells me that Disney did 9% better than expected over the 5 years of my regression. Now, could I do this for every traded stock in the New York Stock Exchange, every traded stock in the US? Sure, I can run this regression. I can get a Jensen's alpha for each one. Let's say I did. I have the Jensen's alpha for every stock in the US. What should the average Jensen's alpha be across all traded stocks? It should be 0, right? Do you see why? Because collectively stocks can't beat themselves. You're saying, so what? When you see a stock with a Jensen's alpha of 9%, if you're a half glass, half empty kind of person, what should you already be thinking about? That there has to be an anti-Disney with minus 9%. Think about that. Tesla's Jensen's alpha is plus 85%. You say, oh, that's terrible. I should have bought Tesla 2 years ago. Before you waste your time regretting what you did not do, just be glad you didn't buy the anti-Tesla. You know what I'm talking about? Because if you have a Tesla with a plus 85%, what's got to be on the other side? There's got to be almost a mirror image of Tesla on the other side with a minus 85%. Say, thank God I didn't buy that stock. Life's too short for regrets. Jensen's alpha is telling you nothing about the future. It's telling you something about the past. And all you can do by looking at a Jensen's alpha is, I wish I had done that. So Disney did better than expected. And that's good because half of all stocks do worse than expected. Thank God you're on the right side of the divide here. But let's make this personal. I'm Bob Iger. I'm CEO of Disney. I came in after that guy Michael Eisner, right, that you guys hated. And he was running the company down. The stock price was down. I've come in, and over the last 5 years, I've delivered this 9% Jensen's alpha. This is good, right? So I said, you know what? I should be rewarded. I need to get a bonus of at least 20 to 25 million, given that I've delivered this positive Jensen's alpha. You see the question I'm asking? When you see a positive Jensen's alpha for a company, does it mean that your company was well managed during the period? Why not? Give me an example of a company that has a negative Jensen's alpha. Management really is not to blame.
If I have a company that is doing nothing, then I have a beta of 0.
Okay, but your Jensen's alpha will also be 0. No, it will be 0. Because you're doing nothing, you're putting your money into cash, you learn the T-bill rate. When I compare you to the T-bill rate, I'm going to say, great, you made your T-bill rate. So it's very difficult to earn a positive Jensen's alpha by doing nothing, right? Now we're on to something. When you look at the Jensen's alpha for a stock, some of it comes from managers making choices, good decisions or bad decisions. Some of it comes from the rest of the world. You know that banks, if you look at between November of 2016 and now, have Jensen's alphas about 18%. The management suddenly become really good after November of 2016. So why are they up so much relative to the market? Because there's this talk about, loosening up the regulation, Dodd-Frank, whatever it is. It's the macro. You had nothing to do with it as management. I'm not going to give you a bonus saying, hey, stock's up 16%. So how do I know if Disney's Jensen's alpha, or what can I do to gauge how much of Disney's Jensen's alpha comes? Some of it must be due to management. Some must be due to the sector overall. Is there a way I can separate out how much of this is Bob Iger's? That's exactly what I did. I computed the Jensen's alpha for the entertainment sector. It's very broad. The average Jensen's alpha for the entertainment sector was about 1%. Now as Bob Iger, you're on stronger ground, right? You're saying, look, I made a 9% Jensen's alpha. It's not because all entertainment companies were going up. They were going up only about 1%. I delivered 9%. So when you look at Jensen's alphas, that is what you're looking at. Is not just what your Jensen's alpha is, but what it is relative to the sector. So if you have an oil company, I take the last 5 years, I can almost guarantee you your Jensen's alpha is negative. Why? If you look at the last 5 years, that's actually, you start oil prices at 100 5 years ago, you're now down to about 45 or 50. You can be the greatest management on the face of the earth. You're not delivering positive Jensen's alphas. But I'm not going to fire you because your Jensen's alpha is negative, because if your Jensen's alpha is only minus 11%, you think, what do you mean only minus 11%? And the average oil company has a Jensen's alpha of minus 25%. You're a hero. So when you look at Jensen's alphas, before you make that jump and say, this must mean my company has good management, just step back and ask, where did that Jensen's alpha come from? How much of it was coming from outside forces, the sector itself, and how much is coming from the management? So let me ask you a final question. Disney looks like a pretty good company in 2013. Its Jensen's alpha is positive. It's done much better than the market. You're an investor, start of 2014, I'll show you this analysis. Should you buy Disney now? Because of the analysis. What's the question I'm asking? When you have a positive Jensen's alpha, does it tend to continue? When you have a negative Jensen's alpha, does it tend? How much? Because if there's continuity, this might be a great way to pick stocks, right? Just look at the stocks that have done much better than expected, put your money in them. This is not a theoretical issue, it's an empirical issue. Is it true? You know what the actual evidence indicates? Where are you more likely to make more money? Is it from buying high Jensen's alpha stocks, stocks that have done the best over the last 5 years, or high negative Jensen's alpha stocks, stocks that have done the worst? This is one of the most perverse findings in finance. If you want to make money in the next 5 years, it's actually the worst Jensen's alphas. You want to take every sector and look at the worst, in fact, my next post is going to be about good companies, good management, and good investments. And I'm going to start the post off with this question. Can a good company have bad management? Throw that question at you. Sure. Why? Because you can be a good company. Aramco is a great company. It earns well above its cost of capital. But is it because Aramco is incredibly well managed? Or is it because the Saudi Arabian government gave you the most valuable oil reserves in the world and endowed you with it? Let's face it, anybody could run Aramco. A machine could run Aramco and will deliver 30% returns on capital. So you can have a good company with bad. Can a bad company have good management? Sure. There's some bad businesses to be in the automobile business. You can be a good management, you're still running a bad company. You're not going to make the return on cap, but you have to then minimize the damage to your investors. So a bad company can have good management. Can a company with, let's get it really confusing, can a good company with good management be a bad investment? Absolutely. You know why? Because if I price you as a great company with great management, if you are just good company with good management, you've disappointed me. Because I thought you could deliver 80% excess returns for the next 25 years with such great managers, and you delivered only a 50% excess return. We have to start separating out companies from management to investments, because there are 3 different levels at which you're gauging the company. And at this stage, all you're looking at is the past of the company and saying, hey, this company was a good investment or a bad investment. Any questions on Jensen's alphas? Yes? Is
it the transaction costs that keep you from beating the market by buying the worst?
That's the biggest, because 2 things happen. When you look at the worst performing stocks, they tend to have low prices. Why? Because your price keeps dropping and dropping. And low-price stocks tend to have higher transactions costs, bigger bid-ask spread. So one of the first problems you run into is this transactions costs. There's a second problem. If you look at these worst-performing stocks, they tend to do better than the best-performing stocks over the next 5 years. But for the first 18 months, you actually go in the wrong direction. Do you know what the second problem is? You've got to have a stomach to sit there with Valiant saying, I'm okay, the rest of the world is wrong. I'm okay, the rest of the world is wrong. And guess what? About 3 months, and he said, maybe I'm not okay, the rest of the world is right. And you've sold the stock. For many people who start off on contrarian investing strategies, they don't have the stomach to hang in there. It's a very, you almost have to have an iron stomach and move to Alaska. Now, even that's not, you have to go where there's no internet. Nobody can reach you and tell you what the stock is. If you could just disconnect from the world and go off for 5 years, you'd probably be much better off. But that's very tough to do. Now let's talk about betas. I told you almost everybody in every investment bank, every consulting firm uses a beta service. I'm going to be your beta service. And we're going to play a little game of, you're going to ask me about the beta, and I'm going to give you a number. And I'm going to try to hang up the phone as quickly as I can. So you ready? You're an analyst. It's 2014. You're looking at Disney. You're too lazy to come up with a beta, so you call me. I'm your service. You pay me $5 million a year to provide you with betas. So the first question you ask me is, what is your point estimate? Give me one number for the beta for the company. What's the best point estimate? I've shown you what the regression is, the slope of the regression. Slope is 1.25, the standard error is 0.10. If I asked you for a single number for the beta, what's your best estimate? This is the 1.25, and then I'm going to try to hang up the phone really quickly, because if you're truly interested in finding out Disney's beta, your second question is, hey, wait, before you hang up, with about 67% confidence, which is not a whole lot of confidence, you're going to be wrong a third of the time, give me a range on the beta. What's the significance of the 67%? It's one standard error, right? Which means the true beta for Disney can be anywhere from 1.15 to 1.35. Do you see what I'm doing? Adding 0.1, subtracting 0.1. So 67% confidence, 1.15 to 1.35. What about 95% confidence? That's two standard errors, 1.05 to 1.45. You know what GoPro's beta is? If you don't know, go check it out on Bloomberg when you get a chance. I think it's 1.6. Kind of makes sense, right? You know what the standard error on that beta is? It's 0.50. 0.50. So think about the 95% confidence interval you're going to give me. GoPro's beta is anywhere from 0.6 to 2.6. Fat lot of good this does me. Plus or minus 2 standard errors. It's not your fault. It's a regression. It comes with noise. I'm going to start digging a grave for regression betas as I'm going along. And this is one of those things that should concern you, is we act like betas are facts, but they're estimates. That Barra beta, that Bloomberg beta that we use, Bloomberg, it actually tells you what the standard error of the beta is right on that page. We never use it. Right? You take the beta and say, I'm done. So we have a slope and it tells us what the risk is. This notion of standard error that I've estimated for Disney, before you think it's just Disney, the median standard error for a beta estimate in the US is about 0.25. Think about that. The next time I tell you the beta for Coca-Cola is 1.1, and I got it from a regression, what I'm not telling you is the true beta could be 0.6 to 1.6, plus or minus 2 standard errors. Betas are estimates. It's a statistical number. It comes with noise. We might as well be open about that noise when we start using betas. Which brings me, so we've talked about intercept, tells you something about performance. We've talked about slope, it tells you something about beta, very noisily about beta. What's the third and final output from the regression? The R squared, right? The R squared for Disney is 73%. If I trust the regression, here's what it's telling me. 73% of the risk in Disney comes from the market. 27% comes from the firm. If I put all my money in Disney, what portion of this risk am I exposed to? All of it. I don't care about R squared because everything hits me. But if I'm a diversified investor, what portion of this risk goes away? You got a 50-50 shot. The 73% goes away, the 27% goes away. The 27% will go away. The R squared for companies reflects how much of the risk comes from the market. And here's one of the things at 2008. 2008 shifted lots of things about markets. But one of the most interesting developments is if you look at R squareds pre-2008 and R squareds post-2008, here's what you find. Pre-2008, the R squared for US companies was about 25 to 30%. Post-2008, the R squared is up to 45 to 50%. So if I asked you for an economic explanation for what I just told you, how would you read that? What is it telling you about stocks today versus pre-2008? More of the risk in every stock is coming from macroeconomic and market variables and less of it from individual companies. And that's a very dangerous place to be in. You see why? Because when the R squared is 25%, you diversify, what happens to most of your risk? it goes away. When your R squared is 45 to 50%, you're diversified, you're still exposed to all that risk. It's changed the way we invest. Because the old rules of just value stock, don't worry about the market, pre-2008, that might have been okay. How can you not worry about the market when half your risk is coming from the market? So when you think about R squareds, that's something to keep in mind, is the R squared tells you how much of the risk comes from the market. And it's not just a number, it's telling you something about how the risk in stocks collectively has changed. And that macro risk, you could argue, is the effect of globalization. That as we've globalized, every company is exposed to more macro risk because we're all connected at the hip to everybody else in the world. Let's nail the R squared concept down. Yeah.
Does the rise of index funds play a part in that as well?
It could. I mean, there are lots of possible things that have happened in the last 10 years to the extent that index funds all invest in the index, they all move the stocks in the same direction. Momentum investing becomes a factor, could be an issue. I think the larger issue is, though, is the underlying global economics have shifted. I mean, you see this often in, every country I go into, the question I'm asked is, if the economy improves here, will the market go up? I was asked this in India last month, and I said, I'm not sure. 30 years ago, the answer was obviously, if the economy is doing better, your market's going to do better. Now the correlation between how a domestic economy does and how the market does in that economy has dropped off dramatically. The last 10 years, the US economy hasn't done well. The US stocks have done really well. And that disconnect is actually what you're going to expect to see more and more as you get globalization, and more of every company's risk is coming from overall macroeconomic factors. So I think index funds and ETFs have contributed, but they're not the key drivers. One final point about R squared, and let's make this about you as an investor. I've kind of given away the answer, but let's make it an explicit example. Let's say you're an investor and I come to you with two stocks. The two stocks look exactly identical in every other aspect, growth and cash flows. Here's the only place they're different. Disney has an R squared of 73%. Amgen has an R squared of only 25%. They both have the same beta. You're an investor. You're a diversified investor. So let's make that the first scenario. Which one of these two stocks would you rather have on your portfolio? The higher R squared stock, the lower R squared stock, or you don't care? Okay, so let's take that. So if you take the lower R squared stock, why did you pick the lower R squared stock?
Because I am a diversified investor, so these...
The 75% will go away. And after it's gone away, what are you left with? Just the beta risk, which you capture with a beta of 1.2. Now, let's say you put your money in the higher R squared stock, 75% R squared. The remaining 27% gets diversified. After you've diversified away, you end up with just beta risk, which you capture with a beta of 1.2. If you're a diversified investor, you stop caring about R squared because, in a sense, you just wash out the non-R squared thing, and it's gone. So when you pick stocks, R squared doesn't even enter into your decision variable because you're diversified. But let's say this is your crazy uncle or aunt. I mean, what does Bill use? A crazy aunt, crazy uncle? No, Bill Silber, doesn't he use a crazy aunt or something? Oh, crazy aunt. That's very sexist. Let's make him crazy uncle. Okay? This crazy uncle doesn't trust these mutual fund guys. He picks only 3 stocks. Why 3? Don't ask him questions. He's crazy. He's got his own paranoid reasons, and he's now come to you for stock advice. You're in big trouble. Paranoid, crazy uncle asking you for stock advice. My advice is, this is the point in time in your life to become a mute. Okay? If he has to buy only 3 stocks, should he buy the higher R squared stock, which is Disney, or the lower R squared stock? In other words, if you're not diversified and you're going to pick 3 stocks, you want high R squared stocks or low R squared stocks?
Does it not matter if you believe that the market will do well, or does it matter if the management?
But that's on the other side. So basically, you can have your views about the stock. Let's leave it on. But in terms of risk, so let's say your views about the stock, your equally strong positive views about both Disney and Amgen. Would you rather go with the lower R squared or the higher R squared? The higher R squared. And tell me why.
Because without the R squared is basically saying that
Most of the risk is market. Whereas if I put my money in Amgen and I'm not diversified, I'm exposed to, I'm like the guy who lives across the highway, runs across 6 lanes to the broker and says, where's my return? I'm taking a lot of risk every day. Right? In fact, if you can slip it by, ask him to buy the stock called SPX. It's actually an index fund stand-in. He just buys symbols, so but it's a good stock for him because then he thought he bought a stock, but it magically matches the market every period. That's an R squared of 100%. Okay. So when you look at ETFs, for instance, you'll often find very high R squareds, obviously, because they try to replicate the fund. The one puzzle, though, is how can two stocks have the same beta, like a setup, and different R squareds? How can you have a beta of 1.2 and have an R squared of 73% like Disney does, and Amgen have exactly the same beta and have lower R squared? Remind me again what R squared measures? The proportion of your risk that is market risk. What does beta measure? The number of units, relative basis, the number of units of risk you measure to. I'll give an analogy that is completely stupid, but maybe this will bring home the R squared example. Let's suppose that Shaquille O'Neal and I decide to have a contest. This is already you can see a one-sided contest. Yeah? Where we're trying to measure the pounds of body fat that each of us has. Okay? Even before you start the contest, of course he's going to have more pounds of body fat because he's bigger. He weighs 350 pounds. I weigh on a good day maybe 130, on a bad day maybe 125. I kind of weigh, But if you think about R squared, you're talking about the percentage of your weight that's body fat. So if you have if you weigh 350 pounds and 5% of your weight is body fat, 5% of 350 is 17.5 pounds. Let's say I weigh 125 pounds and 10% of my weight is body fat. 10% of 125 is 12.5 pounds. I have a higher percentage of body fat, but lower pounds of body fat. That's a way to think about R squareds and betas. R squared measures the percentage of your total risk, it's market risk. And Amgen has a lot of total risk. Beta measures the number of units of market risk you're exposed to. So when you look at your stock, you can look at the R squared and look at the beta, and if you get a disconnect, don't get too frazzled. It can happen. You can have a technology company with a low R squared and a high beta. You can have a utility with a high R squared and a low beta. You can get all kinds of combinations here because you're measuring market risk in two very different ways. So now let's bring it to Bloomberg. As I said, 25 years ago, at this stage in your project, I'd have asked you to go collect the price data for your company, collect the dividend data, run the regression. All you'd have learned is the tediousness of entering numbers in an Excel spreadsheet and running the regression. So I'm going to save you the trouble. For your stock, you can use Bloomberg because Bloomberg runs the regression for you. But to see what Bloomberg does, here's what I'm going to do. I'm going to take the Bloomberg beta page for Disney using exactly the time period that I ran the regression in to make sure that our answers match up, because if I take the same stock, same index, same time period, same return interval, our numbers should match up. Right? So what I'd like you to do actually is to go back to my regression, which was on this page. So you stay on this page, I'll start on the Bloomberg page, then I'll tell you to catch up with me. Okay? So this is my regression. Let me go through the Bloomberg page. And let's see if their numbers match up to mine. So I picked the same 5-year time period, the same market index, the S&P 500. I used monthly returns, and I ran the regression. So let's start at the top. Raw beta. You're saying, what's raw, cooked? No, basically, raw beta is basically a regression beta. We'll come back to the adjusted beta. So the regression beta that they come up with is 1.247. What did I come up with? 1.251. Shouting distance, I'm okay with that, pretty close. We'll talk about why you get even that mild difference. Then they have alpha, intercept. So that's actually their intercept, not their alpha. Their intercept is 0.599%. Bloomberg is incredibly sloppy about percentages and decimals. As I go through this page, just put the units next to it. So when they say 0.599, it's not in decimals. It will be 59.9%. It's actually 0.599%. My intercept was 0.71%, so I'm off by 0.12%. And when I first started using Bloomberg pages, this would drive me crazy. Why is my intercept not matching up to theirs? Same time period, same stock. And the answer is actually very simple. When I computed returns on Disney, what did I do? I took each month, I took the change in the price, and then what else did I bring in? If there was a dividend, I brought it in. When I did the returns for the market, I took the change in the index, and if there were dividends in the month, which usually there were, I brought them in. So when I computed returns, I included dividends both in my stock and the market index. Bloomberg doesn't do that. Why? Because it's a computer running these. It's not like there's somebody putting in. It's easier to run the computer with price change and no dividends, because dividends are not every month, right? They show up every 3 months, every 6 months. So their regression is run with price changes on the index alone. They don't count the dividends, which means that they're going to be off by a little bit or a lot, depending on how much dividend your stock pays. With Disney, it's not a big deal. It's 0.60% versus 0.71. My Jensen's alpha will still be 8% instead of 9. And for most of your companies, it's going to be close enough. But if you're doing a REIT or a master limited partnership, you know why I picked those? Because they tend to pay big dividends. You can get betas on Bloomberg that are very different than the betas you would have got if you'd run the regression yourself. The R squared they got was 73.4%, which is actually very close to mine. So their beta is pretty close to mine. Their intercept is lower by 0.1%, but it's close enough. And the R squared is 73%. So now you can see why I'm going to let you use the Bloomberg beta page. It's not perfect. But think of how much time it saves you not having to run the regression yourself. The standard error of the beta that they got was 0.099, very close to my 0.10. So in fact, the numbers look very close. The one number there that I didn't have in my regression is an adjusted beta. Bloomberg estimates adjusted betas for every single one of the 40,000 companies that you can pull betas off for their page. Sounds fancy, right? Adjusted. Adjusted for what? In the old days, actually below the box actually used to tell you how they adjusted the beta. And here's what they do. And as I go through, think about what they're doing. They take the raw beta, which is the regression beta. They multiply it by 2/3. And then they take 1 times 1/3 and they add the two numbers together. So what? Let's try this out. Your regression beta is 1.8. Take me through the process. 2/3 of 1.8 is 1.2. 1/3 of 1 is 0.33. 1.8 will become 1.53. So the adjusted beta will be 1.53 for a raw company with a raw beta of 1.8. If your raw beta is 1.5, your adjusted beta will become 1.33. If your raw beta is 1.2, your adjusted beta will become 1.13. If your raw beta is 0.6, your adjusted beta will become 0.73. What the hell are they doing? What's your adjusted beta pushing your beta towards? Every one of these companies, it's pushing it towards 1. What's so magical about 1? It's the beta of the month. They're trying to be helpful. They're saying, you know what, your company will probably get bigger over time. It'll probably get more diversified over time. So we're going to push your beta towards 1. To which your response is, please stop helping. Because these weights, 0.67 and 0.33, 2/3 and 1/3, are the weights they use for every single one of the 40,000 companies. I could ask you where the weights come from, but it wouldn't be fair. So I called Bloomberg. Not the mayor, but the company. Maybe he was still the mayor. I should have called him. Maybe he'd have given me a better answer. So I called the company, and they put me in touch with a beta calculation guy at Bloomberg. There's actually a guy whose life it is to maintain this page. Can you imagine how exciting his life must be? He goes to a cocktail party and says, I'm the beta guy from Bloomberg. Dozens of people gather around for anecdotes. Not. He picks up the phone. He's pathetically grateful to get a call from the outside world. He says, I'm so glad you called. I've all day, they must keep him locked up in a basement room or something, feed him through a hole in the wall. Right? I'm so glad you called. I've all day to answer your questions. I've all day to ask him questions. But I was afraid he'd do something rash if I hung up the phone too soon. So after a few minutes of polite conversation where I complimented him on the fact that it's a nice service to have, I hit him with a question. Why 0.67 and 0.33? 2 minutes of silence. I can hear papers being rustled, terminals being turned off and on. Finally comes back and says, I don't know, it was here when I got here. I said, what? He said, I was hired 2 years ago, it was already here, don't blame me. So I'm not trying to blame anybody. I want to know where these numbers come from. You seem to be using them on every company. He said, I don't know, here when I got here. I just finished my 11th book at the start of this year. I have the title for my 12th book picked out. I haven't written a word of the book, but the title is the most critical part. It's going to be called Here When I Got Here. Because you know how often that's the answer to questions you ask about numbers used every day at work. Why do we use this number? I don't know. It's here when I got here. When did you get here? 1979? You've never stopped and asked? No, I just do my job, I go home. I'm not going to look for trouble. Here when I got here should never be your answer, no matter what the question is. And that's, I think, part of the problem in finance is we've outsourced so much of what we do. Where do you get your betas? Bloomberg. Where do you get your risk premium? Duff and Phelps. Where do you get your risk-free rate? The Treasury. Where do you get your cash flows? Management. What the hell are you doing then? Because you're just a concierge then, right? You're collecting all the stuff, you're putting into a spreadsheet, you're plugging in a number. Can't be here when I got here. So the bottom line is when you pick that Bloomberg beta page, take the raw beta, the intercept, the R squared, don't even go with the adjusted beta. All it's telling you is which direction one is. And if you are having trouble with that, then I don't think your troubles are solvable. Right? So if you're at 1.8, you want to get to 1. How do you get there? You make your beta lower. You go 1.6, 1.4, 1.2, 1, you're there. Why do you need some guy holding your hand saying, in case you're confused, let me give you 1.53. That's closer to 1. I would never have guessed. Every single service uses words like predicted beta, adjusted beta, forecasted beta. Don't fall for it. They're all regression betas moved towards 1. And they all have exactly the same prompts as the regression betas. So now let me bring this all together into one number. Now, the equity risk premium has nothing to do with the beta. Your cost of equity will. We'll talk about that. I mean, I'm going to use none of the above, but for the moment, let's act like we have a regression beta, and let's see how it plays off in the cost of equity. I have all kinds of worries about this regression beta. It's backward looking, it's noisy, but let's say I'm willing to go with it. Let's bring them all together in my cost of equity calculation. So this is the page I've been leading up to for 100 pages. Right? So now I have a risk-free rate. The risk-free rate in November of 2013 is the US 10-year T-bond rate. Why did I use that? Because I'm doing my analysis in US dollars. The beta is the regression beta. For the moment, let's go with the raw beta, 1.25. And the equity risk premium, 5.76%. Do you remember how I got that? That's a weighted average of the equity risk premiums of the parts of the world that Disney operates in November of 2013. Everything has its place. Your risk-free rate defines the currency you're in. Your beta measures your risk as a business. Your equity risk premium reflects where you do that business. I get 9.95% as my expected return. In every finance class, you do this until you get sick and tired of doing it. Risk-free rate plus beta times risk premium. So I want you to give me an intuitive hook to hang this on. Something where if I'm trying to explain to somebody who has absolutely no idea about the CAPM, doesn't care about betas, doesn't care about risk-free rates, what this means. And I'll read two statements to you, and you tell me whether you think these are fair ways of describing that 9.95%. Here's the first statement. 9.95% is the return you can expect to make in the long term on Disney if the stock is correctly priced and the CAPM is the right model for risk. That's a heck of a lot of qualifiers in one statement, right? Let's go through. Expect to. No promises. Long term. Don't come to me next year. Correctly priced stock. And the cap. So if all of those things hang, this is a very antiseptic way of describing the 9.95%. In fact, if you believed in efficient markets, that is the way you'd read the 9.95%. If you want to make more than 9.95% in this world, what would you have to do? You'd have to go to a higher beta investment, more risk. I don't like that definition because it means that I can't teach my second class, which is a valuation class. So I'll give you the way I like to think about the 9.95%. 9.95% is the return you need to. Suddenly you become a very needy individual. You need to make on Disney to break even on your investment in the stock. Why couldn't you settle for 2.75%, which is your risk-free rate? Because if you wanted to make 2.75%, you'd buy a T-bond. You wouldn't buy Disney. You need to make 9.95% because it's danger and opportunity. You're exposing yourself to risk, and you need to make the 9.95% to break even. And here's why it helps me. Let's say I am interested in investing in Disney. I'm a value investor. I go do all my research on Disney. I collect the information on its theme parks, its movies, its broadcasting. I do my research, and I conclude based on my research that I can make 12.5% a year for the next 5 years on Disney. What do I need to make? 9.95%, right? I think I can make 12.5. What does it make Disney to me, a buy or a sell? That's my buy, because if I can make more than the 9.95%, I have a good stock. That's what we do in valuation. That's why we need an expected return, a hurdle rate, because without it, we're lost. Because if I just told you 12.5% in Disney and nothing to compare it to, you can't make a judgment on the stock. So I'll close with one final question, and we'll start with this next session. 9.95% is the return I need to make as an equity investor in Disney, right? You're all equity investors in Disney. You all need to make 9.95%. I'm the CFO of Disney, and I talk about the cost of equity. What's my cost of equity? It's what you need to make. That 9.95% you need to make to be okay becomes my cost of equity. We have half of the cost of capital component fed down. Now you ask me, what's my cost of equity? I'm not making up a number saying this is what you need to make just to break even. And that's why we need a risk-free rate and a beta and a risk premium. And I'll consider right now my weakest link in this equation is that beta. I don't trust it. The risk-free rate I'm okay with. The risk premium I can live with. That regression beta scares the heck out of me. So next session when we start out, we're going to talk about how we can replace that one slice of history regression beta with something that's more reliable. So I will see you on Monday. Yes. Like what? How do you get exposed to other risks if you're not operating? From what? Either your factories have to be exposed or your sales have to be exposed. Risk doesn't operate in kind of an ether space, right? So if your country level risk, you're worried about your factories being nationalized, that's operating risk. Give me an example. When you say other, I'm not sure what you mean. And what if you get no revenues in that country? So who cares if there's a scandal in your country if it doesn't affect your business? Right? If you have factories in that country and that scandal then becomes a scandal. So if you're in a South Korean company and you're saying, look, what's happening to Samsung, that could spill over and your factories are in Korea. It's because your operations are exposed to that risk that you worry about. Right?
So basically, the country level estimators we get are like macro.
Those are for the country, and you're exposed to it only to the extent that you're exposed to it.
With them by their
Exactly.
that's taking it.
Exactly.
So I emailed last week, but I guess we're busy
Yeah.
time. So I was asking about when we were doing the corporate governance analysis, we want to find some evidence regarding whether the board can be a check on the manager or not.
Right.
So if, say, this company has a recent merger acquisition, and there are some like financial commentators that are saying, "Oh, this is not a good deal because blah blah blah."
They'll always be. So that's not going to be. That's neither here nor there. So that you can't read either direction, right? So.
Okay.
So just the fact that some people think a deal is a bad deal. When has there ever been a deal that everybody said was a great deal, right? So you have to be careful not to leap from that and say that must mean poor corporate governance is bad, because you might want to look at something more tangible. If you can show